Now, of course, I want to bring in our guest, Rebecca Walser, president at Walser Wealth Management. Rebecca, thanks so much for joining us. Welcome to the show. What's your reaction so far to how markets have opened about halfway into the trading week here?
I think top to bottom, the market just doesn't exactly know where it's going to go, Chloe. And if we look at, the San Francisco Fed just came out with some analysis saying that the, sustained inversion curve, the inverted yield curve, yesterday the two into intraday trading hit a 511 and settled lower 505. But the point is that we've had this sustained now for a long period of time, and it's the highest inversion we've had since basically August of 81, 110 basis points between the 2-year and the 10-year. And so when we look and we see all of the recessions that have happened since 1955, this has been one of the barometers that has never projected it incorrectly. So I think even with Powell, his higher for longer hawkish sentiment yesterday, certainly the market is finally realizing, as I've said on Cheddar since the beginning of the year, this is going to be an extended race for a higher terminal rate. The market really wanted to look at the lower end of the terminal rate. We always saw that the terminal rate was going to be somewhere in the 6s, potentially. It's in the 5 to 7 range. So we had prepared that this would be the Fed's stance. We told our client base, Powell has no choice. This is what's going to happen. So far, he's been following exactly what we've said. And, it's not just the Fed, though. We've got to look at how it's impacting the S&P. We obviously had a 3.2% year-over-year decline for Q4, and the projections are a 4.5% decline for Q1 that's coming up ending in March. So it's not just the Fed, the overall economy, the credit card rates that are going up, the amount of percentage, it's all together. It's all coming together as leading us to some bad situations for 2023.
Absolutely, Rebecca. And, Powell really facing some tough questioning, particularly from Senator Elizabeth Warren, considering, the state of the economy, potential job losses here. In that testimony, was there anything that surprised you? What are you anticipating as well from the next Fed meeting here in terms of rate hikes?
Yeah. So for March 22nd, the meeting that's coming up, I definitely think that based on his comments and how hawkish he was and really trying to lay the groundwork for the market to prepare for a bigger than 25 basis point hike, we probably are going to be at a 50 basis point hike. Let's keep in mind, if we have to be somewhere in the 6s with 25 basis points as the only thing they're leveraging, that's going to take too many iterations. It's going to make the market drag out the inevitable. So I think that Powell is really trying to let Congress know and the world know that the market's expectation, I've been saying this, I feel like I'm a broken record, but the market expectation of some kind of pause or even pivot in 2023 is not realistic. And he's constantly having to, he's fighting the market on this one because the market is fighting what he's been saying since the beginning. The truth is the data always showed that the terminal rate was going to have to be higher. And all of the economic, information that we've gotten, PCE last month, everything is still showing that it's sticky. Inflation is sticky. And that, somehow, some way the global economy is more resilient and there's still job openings. There's still we're still beating now on the ADP report that is out this morning. So it just further shows that this is an economy that wants to grow, which means inflation is going to keep pressure on it. Yet there's other indicators that say, oh my gosh, credit card usage is your big one. We're a 70% based consumer economy. When consumers can no longer go out and spend money because the credit cards are maxed, this is where we're at. We have to worry about, okay, they've gone through their savings, they've gone through their credit cards. Now, where is the money going to come to keep sustaining the economy and the economic growth? And that's when we're getting into recessionary territory. So it's a difficult road that Powell has ahead of him.
Yeah, Rebecca, and speaking of an economy that wants to grow, the jobs report last month came in way overheated, 517,000 non-farm payroll jobs added. We have the big jobs report coming out on Friday, but we did get ADP jobs data out today, coming in a little bit hotter than anticipated. Obviously, last month that did not prove a good indicator for what the jobs report actually ended up being. So based on this ADP jobs report, what are you kind of anticipating that the major jobs report on Friday is going to look like, that February jobs report?
I mean, I hope we actually do get a beat. I hope that we are to the positive. I mean, that's not good for Powell, right? Because that just, again, says that the economic conditions are showing that the market is going to keep trying to push. And this is the small and medium-sized businesses. It's not corporate America. It's not Fortune 100, Fortune 500, because we are seeing layoffs, massive layoffs. You just mentioned before in the lead-in about Meta continuing to cut costs. So we're seeing Fortune 100, 500 with massive sort of broad spectrum layoffs across sectors. But it's the small and medium-sized business engine that is growing these jobs. I know as a small business employer, we have jobs that have been outstanding for 18 months. This is the most difficult job market totally I've ever experienced in my life. And so I think that that's what employers are feeling. They are still growing. They are still trying to conquer this market. And yet the people are missing. Where are the workers? And so this is going to be a constant thing where Fortune 100, Fortune 500 are cutting, but the small and medium-sized businesses are resilient and they keep saying, we're going to keep going.
Hey, Rebecca, we have about a minute left here, but I just want to ask you about fourth quarter earnings season. It's nearing its end. Oppenheimer has suggested that we've actually seen earnings shrink by about 3% while revenue has grown. So what's your take on earnings season and what it says about the year ahead?
Yeah, I think obviously it's different by sector. And obviously we expected maybe energy to really have a great breakout if China really got fully back. But now we're starting to see the analysis and the data showing that energy's got some big problems. OPEC is just saying that energy needs massive investments as of yesterday. So I think that overall we do have an expectation. I'm expecting that the March Q ending earnings are basically going to be down anywhere from 3 to 5%. I'd say maybe 4 to 4.5 is kind of the consensus. And I don't think that is going to change because we do have this mixed bag. We have some parts of the economy that are really trying to sustain and go forward, and we have other parts that are really cutting back. And obviously, so far we didn't see that with Airbnb last month. We saw obviously that people are still spending on excursions and personal experiences. But as far as retail and actual consumer durables and goods like that, I think those will be fine. But the actual luxury items and those kinds of discretionary spending items, we're going to see
Rebecca,
a pullback.
We got to leave it there, but thank you so much for your time today. We'll be back on the other side.